Welcome back everyone, thanks for joining. In this episode, we'll be looking at how to find a decent dividend stock. There was a lot of positive feedback from the previous episode on the portfolio and a few questions as well on how to find a dividend stock and what to look out for. So I'll be sharing just a few things that I look out for and where to find them. To start off, what you need to know is your time horizon. So I touched on this in the previous episode. So is it 5 years, 10 years time, 20, 30 years time? When is it that you actually intend on living off your dividend income? This question is important because the longer your time horizon is, then the more you'll benefit from dividend growth rates and you can allow for lower starting yields. Whereas if you're on a shorter time horizon, you may want to look at then higher starting yields and can allow for lower growth rates. That is why it's important to always evaluate your own personal goals, and you can get some understanding using a dividend calculator, which I touched on the previous video. There are a few different sources you can use to find and analyze stocks. As a dividend investor, you will soon realize that the US have a lot more strong dividend paying companies than the UK. A good website to use is Seeking Alpha. You can create an account for free, and if you have some positions already, you can input them into their portfolio. In here you can see my stocks that I've already input into the portfolio. Now as you can see here, there's a lot of data that hits you straight away on the page. A quick and useful indicator on the right hand side is a 52-week range. This indicator shows where the stock price is currently sitting in comparison to where it's been in the last year. This can indicate if it's at a good value right now or not. So as you can see here, Caterpillar is sitting at the top of their 52-week range, and if we scroll down, you can see other stocks quite clearly, which are sitting at the bottom of their 52-week range. If we go to, for example, AT&T here, are sitting at the lower end of their 52-week range, which could indicate they may be of value. But we'll definitely need to look at some more metrics. It's always nice to be in the green. However, with a long-term outlook on dividends, over time it bears less importance, but it's always nice to enter the position at the best possible time. What we do know is that as share prices rise, the dividend yield lowers. So by entering at a low 52-week range means that you'll be getting one of the best dividend yields possible in the last year. So to look further into these stocks, what we'll do is click on the dividends tab. Here you can see quite a few different metrics. First of all, what we'll look at is the yield, which is displayed here. If we just sort these yields out, it puts it in order from highest to lowest. Note that there isn't information for some of the UK stocks on here, and you may need to source it elsewhere. Now the yield obviously is quite important, but it isn't something that you want to go off alone. So what we will then look at is the payout ratio, which is displayed here. This indicates the sustainability of a dividend. Ultimately, it's a percentage of a company's earnings that are paid as dividends. For example, if a company made 1 million in earnings, then paid 1 million in dividends, their payout ratio would be 100%. If they paid out 500,000, it would be 50%. Now, if the payout ratio is over 100%, that shows a company is paying the dividend by other means, which can be seen as a bad sign, as it wouldn't be sustainable. A key thing to understand is that different payout ratios can be accepted for certain sectors. For example, utilities and REITs will usually have a high payout ratio, as most of the profits will go to shareholders in dividends and are heavily regulated, etc. So an 80% payout ratio isn't frowned upon too much in those sectors. However, generally, under 75% is a good place to be for most other companies. Next, I'd usually check that the company has a solid dividend growth rate. Once again, growth rate expectations change as per sector. On average, between 6 and 8% is a decent growth rate. You can see here AbbVie have a high dividend growth rate and also have a 5% yield. Starbucks have a low yield at 1.9%, but then have a high growth rate, which if they was able to continue to grow the dividend at a similar rate in the future, you would benefit quite well. Now what we'll look at is a low growth rate, like AT&T. Yes, the dividend growth rate is quite low, but what you will notice is the dividend yield is at 7%, which is quite high. So with having a yield at 7%, if they had a high growth rate, the dividend may not be sustainable. So if the growth rate was also high, the company could struggle to pay the dividend in the future. Another one would be Duke Energy. They've got a decent yield but poor growth rate, but once again, that's expected in their sector. Same with Realty Income, decent yield but not a great growth rate. You can also use the years of growth tab. This shows how long the company has been growing their dividend for. Some of these companies have still managed to raise their dividends even through difficult financial periods and market downturns. Now we can click on the value tab. A metric we're going to look at here is a PE ratio, which is a price to earnings ratio. We can use this to see if the current price is good in relation to what the company has earned. You can see here that Starbucks PE ratio is very high compared to earnings, so it could be considered overvalued. However, if you have a long-term view on Starbucks and believe in their fundamentals, then you may see past this. Generally, the lower the PE ratio, the better. But in some sectors, you'll most likely always have higher PE ratios, like some tech stocks. With the PE ratio, you can sometimes fish out some good value with companies with a low PE. The quick ratio is quite an interesting metric, as it measures the ability of a company to use its near cash or quick assets to pay off its current liabilities immediately. A decent quick ratio would be 1, which would indicate a company is fully equipped to pay down its liabilities straight away. You can see here that Leggett & Platt are well positioned to be able to do this, and all of them above, whereas anyone below may find it more difficult. It's always important to know that not one ratio or metric can determine completely a company's sustainability. What we'll do now is look a little bit deeper into Leggett & Platt. If we then go to the dividends tab here, you'll then see a summary here. What you then want to go to is dividend growth. Click on the All tab. This is what you want to see, a steady rise in dividend growth over the years. You can also see their growth rate here is around about 5%, which isn't too bad. We can click on the dividend history tab also, which shows you a little bit more data. Now we'll go to the dividend yield. We can see that the current yield is at 3.79%. Here you can track the yield over the years, what it's been, to see if 3.79% is a good yield. We can see here that from 2014 more or less to 2019, the yield is at 2%, touching 3% sometimes, and peaked obviously over the pandemic. This would have been a great time to buy in to Leggett & Platt, as you'd be receiving a 6% yield, which to get a 6% yield, you'd have had to go way back to 2012 to get even close. 2011 was the closest you'd probably have got to that. So that's why it's important in downturns to still invest and stay invested with your stocks and not to panic. So 3.79%, as it's lowering back down to where it's been in the past at the lower threes, may be a good time to still get into the stock. The yield on cost tab is also interesting, which shows if you had invested into Leggett & Platt, what yield you'll be getting now. So 10 years ago, if you'd invested then, your yield on cost would be 8%. And obviously, if you was fortunate enough to be invested way back here, you'd have a yield on cost of 40 to 60%. Now, another good source to search for stocks is on CNBC Stock Screener. On this screener, you can customize different criteria to meet what you're looking for. So if we adjust this here, so we'll make those adjustments. And you can see here the companies that meet that specific criteria. What we'll do is we'll put one of these companies into Seek and Alpha just to look at it a little bit further. So we'll go with Steel Dynamics. with their ticker symbol STLD. We can see here they've got a respectable dividend yield, a low payout ratio, and a really good growth rate. Been growing a dividend for 10 years. So if we go to the dividend growth tab, we can see it's trending in the right way. It's not going up and down and fluctuating. Dividend history shows it going in the right way. If we go over to the dividend yield, we can see here historically it's traded at quite a low yield, so 1.5% or lower. Then it's risen to mid 2%, touching 3 sometimes. Obviously, height of the pandemic, we're at 5%. Once again, perfect time to enter into this position. And we can see it starting to trend down a little bit now. So it shows that it may be a decent time to enter the stock whilst the yield is high. Obviously, with all of this stuff, this is all just the numbers and financial side. You'd still want to look into each stock and actually see and determine what the company do, their future, and if you like them as a company. So that's a quick way to check, I would say, some US stocks on those different platforms. Now, as I said previously, the UK don't have as many good dividend paying stocks as the US, but you can track a few of them here on dividend data. Now, what we can see here are the dividend yields for dividend paying stocks in the FTSE 100. Now, the stocks highlighted in red have cut their dividend. So it's a quick way to see if these stocks aren't paying a dividend currently and if a company's been able to maintain their dividend. Now, to look further into the UK stocks, I'd recommend using Yahoo Finance. There you can see some metrics here, not displayed as well as on Seek and Alpha, but you can more or less get a feel for the company. Right guys, so what we're going to do now is head over to the portfolio. We're going to have a quick look at Trading 212 and see where we can find the metrics over there. So what we'll use here is, we'll go into 3M. It's quite a good company to have a look at. So here you can see their figures. We'll scroll down here. We can see the PE ratio. We can see the dividend yield quite easily. Some of the metrics we've been looking at today. What we also have here is the financial summary. We have the balance sheet, cash flow, income statement. All of these things are accessible here. We can see the 52-week highs and lows. We'll scroll across here. We can see now the current ratio, quick ratio, payout ratio also, which is easily accessible here. There's a lot of other metrics on here which are great, which I won't go into today, but you can use them if you wish. We've also got the PE ratios all here as well. That's what's great about Trading 212. You've got all of this information quite easily accessible to you. There's also growth and debt and other metrics here also that you can get into. What we'll do now is we'll have one quick look at another company. We'll go into Ashtead. Here you can see quickly how well the company's been doing over the years. We go down here and what you can see is how well they've been growing. It's easy to see here in graph form. You can see that they've been rising in their revenue here. And if we go down more, we can see balance sheet and other things here. So these things are useful, not something that you should go off on their own, but it's nice to see and have access to. So that's what's great about Trading 212 and why I moved to the platform also. Thanks guys, I'm going to leave it here today. I hope that you found some use with the video, and we'll see you soon. Please like, comment and subscribe, and see you next time.